Ira Epstein with your financial market wrap-up, and this wrap-up is for Wednesday, and we are now at the 26th of January, 2022. Sorry I missed you all yesterday. Had a funeral, and unfortunately I lost my kitty. So not a good day for me. I was exceptionally upset, heartbroken today. You lose your pal. If you have a dog, cat, doesn't matter. You end up loving them. All right, so to make a long story short, today was the Fed day, and what the Fed made clear to me at least, we're going to get a series of rate hikes until the economy does what the Fed wants in terms of controlling inflation. Fed Chair Powell, I think, made it clear we're running at full employment. Fed Chair Powell said the balance sheet is not the main tool he's going to use. The main tool that the Fed will use is going to be the Fed fund rate, interest rates. So you got your information. While Bill Ackman and other great traders would like to see a half-point rise in it, I don't think you're going to get that. I think it's going to be deliberate because at its heart, if you listen to the Fed chair, listen to the man, the Fed still thinks that inflation can fall back here if the supply chains fill, if Omicron or whatever other variant comes out, because there are other variants already coming out of this, if they don't do damage to the economy and this is it, we learn to live with this, inflation falls back. So the people that are predicting 7, 8 hikes, some 4 this year, they might be right. It depends how the inflation falls back. It's that simple. Do I think he baked in the quarter-point hike for March? I do. I don't see anything to change that right now. Do I think the market is still going to be data dependent? I do. Do I think that the Fed is going to run off the balance sheet after they finish the buying program? I do. What I didn't get is why not just end the buying program? Be done. What's the magic of just stopping now and letting for the next 7, 8 weeks until you get to March be done? That I think they could have done, but they didn't want to. The Fed is deliberate. They go in their own plotting way, and that's what you want. You want them to be stable and telegraph everything to you. Okay. So we look at the S&P as the Fed chair was talking, and afterwards, the market, which had been up about 400 points in the Dow at that point, just turned the corner and went into negative territory. You'll see that you failed also in the S&P. The S&P down again, 36 points for the week. You can see you're down another percentage point. And if you add up where you were on a closing basis weekly, you were down 1.9%. Add to that another 0.2, so 2.2%, 2.3%. Add to that, let's call that 8% decline right through there. Add to that another 9% decline. Closing basis only, not highs to lows. Closing basis only as of right now. So knocking on the door of what theorists call a 10% correction on a closing basis. Certainly you're more than that from high to low. You can see that. You don't need me to tell you that. The pattern of the trend is down. You got down to an area at the 412, 1275. You had a bounce over the past 72 hours, and now you're sort of slipping. Where the market got under the 200-day average on the way back up, those averages become resistance. So the first one is the 200-day, and you can see that you're fighting there. What's probably going to happen by early next week at the latest is the 18-week average of closes is going to get under the 100-week. That'll be a bit bearish in the market. So you're laying up an awful lot of resistance areas up here. As we step over, I'm sorry about that ringing. As we step over, and you can see how the Bollinger Bands are, you moved from being under the Bollinger Band to the right-hand side of it. That makes sense to me. When you look at the slow stochastics, they're oversold territory, not trying to embed. So I don't think you're going to have ease in getting under that number at this point in time, and I think you handle that accordingly. Let the market just slip away on you, not much to do with that one way or the other. In the Nasdaq, are we going to embed? Let's first go there, because that to me is one of the most important tools. We cannot count today. On the close of business, Wednesday, both numbers were under 20, both under 20 the day before, both under 20 the day before, the day before, the day before. You've been embedded. Embedded means until the red line closes over 21 I'm going to look for this market on rallies to get sold, to drive it back down. But when you close over 21, unless you come back the day afterwards, right away, get back both numbers of the slow stochastic under 20, the odds favor you're going to make a run at one of these main moving averages. That's how I use that momentum. It's pretty simple. It's in my enhanced Bollinger Band course. Believe me, I didn't teach you the secret right here. That's the enticement. You want to take the course. In the Dow, we have lower highs, lower lows, resistance. All you did is bounce to the 200-day average, and I'm going to repeat. When you get under these numbers, they become natural resistance points. Does the market have to stop at them? No, but that's what you're looking for as a chartist. So first resistance, second, third. And you can see in this market, I think you're also going to get a bearish crossover sometime next week. It would take a huge rally in these markets to not have that occur. In the Russell, you have the embedded reading at work, means the rallies are getting sold. Today would have been, had it not been Fed day, a day I would have been extremely aggressive in putting out sell recommendations on this rally. Did not do it. I learned many, many years ago, and I have followed it. Each time I go through a major report, because I say it can't mean anything, I get stepped on. It can happen in corn, cattle. It doesn't matter the market. I've learned my lesson, and you got to learn it early on. You become a wise guy and go, that's just not that important to report. It can be. So, still embedded. I think the pros are selling, but I think they will cover down here. And you get a window envelope. If you haven't taken my full charting course or don't take my morning subscriber videos, there's a window envelope you always want to look at because it's the closest of the Bollinger Band to the window envelope, especially if the window envelope is right in front of that market. And I give you those window envelope numbers with your paid subscription, both in spiders, ETFs, and futures. And I do them several times a day. Higher lows, higher highs. I don't think you're going to hang well over that upper Bollinger Band. So I look for a pullback. The pros are in trouble. I made mention of this in my subscriber video. I think the pros went short back over here, looking for this market to hang in this area and come back to these averages. I pointed out that each time you sell those, there's a lot more pressure than the guys that come in and write against the lower band because you typically bounce away very quickly. When you're down to a 10, 12, 14 range in the VIX, it's hard to get the market to collapse underneath you. When you're at an 18, 20 area, it's nothing to get into the 30s or 40s in a VIX. And that's the danger of writing the call. And that's what's happened. The best I think these traders will do if you get a hard break, I don't think they'll break even. I think they'll have to take a small loss if they haven't taken a loss already. In the bond market, no trend. Lower low, higher high. Notice where the market rallied after you lost the embedded reading. Here's the embedded reading. You lose it. I'm looking for the 18-day average. You get it, and this is where you're at. I'm now looking for new setups to get into these markets, be it the 10-year note did the same thing, the 5-year, all of them. In the dollar index, it might cap off this rally by hitting the upper Bollinger Band. You've got a window envelope up here. You've got to pay attention to that too since you're overbought. And it's the flip-flop in the euro. Since 40% of the dollar index is made of the euro, you rarely want to be short the euro, long the dollar as a trade another currency. And what's happening there is that is oversold and knocked on the door of the Bollinger Band. I think the pros took some money off the table today. In the British pound, you can see how it's coming down. Boris Johnson's got his hands full. The Bank of England, they want to raise rates. The Bank of Canada, they surprised the market today. They were supposed to. The market had built in, I think, a 70% probability, if you looked at how the option strategies and all were working, that was going to happen. It didn't. They, for whatever reason, decided to let the Fed make its statement first. Bitcoin. Well, Bitcoin at any point here can give you a rally back to the 18-day average, but you've broken the back of the market. The question is, does it have any downside left in it? And as I told you, when I heard on Bloomberg an announcer this week come out and say, I'm getting counts to 10,000 or 5,000, that might be a right thing eventually. I don't know, but it's grandiose. That's the same as when I saw, and I thought it was the kiss of death, Tom Lee from FactSet come out and say it's $400,000. He has said that so many times. It's grandiose. It's grandstanding. Hey, if I'm right, I'm going to get a lot of followers. If I'm not, they'll forget it. And what's the difference? I don't talk in that jargon. I don't believe in that jargon. I think there's support at 35,712. The trend is down until it's not down. The market is working off an oversold condition to be out of it. Both numbers in the slow stochastic have to be over 30, and they're not. In Brent versus WTI, look at the collapsing here. Now, it's time to move out of the March, so I've got to change these to April, and I will do that right away for you. I'll be getting rid of the March Brent too. It's going off the board now. But you can see how the market is moving up and away. These markets are pricing in the event of the Ukraine. We don't know what's going to happen. President Biden's team delivered today in person the written response to the Russians. I cannot imagine that the U.S. written response is giving Vladimir Putin what he wants. We're not going to say, you're right, we're not going to let the Ukraine join NATO. And no, any of those other countries that want to come in, hey, they were old Russian countries. They can't go either. And no, you're right, we shouldn't do war games in the Ukraine. Oh, we're not going to do those things. You can amass all the troops you want there. It's fine. In fact, remember what he said, take that couple 100,000 acres. That's not a war. That's a small intrusion. Well, got his head handed to him. We got soldiers on station. We are not going to commit troops. I do believe, to fight the Russians face to face on the ground. But we will be behind the scenes if there is a problem. And now the question is, it's all now up to Mr. Putin. His game. He created it. He's got his answer in writing. Is there room for wiggle? Is there room for him to back off? Or does he say he's played his cards, he's got his war chest, he's built a heck of a war chest, by the way. Is he prepared for the sanctions that come down on him? Can he deal without the SWIFT system? And there is another system for them to do banking on. Can they deal in their oil and gas without dollars? Because that's going to be a problem. It's priced worldwide. Energy's priced in dollars. Can he deal with all that? And at the end of the day, is it worth grabbing those two elements? Those two elements he's after. Those people have a really strong relationship with Russia. There's no question. It comes from there. It's the rest of the country that wants that. You can't just give a piece. He did that in Crimea. Is he going to grab more? Who knows? All right, I'm not a politician. Don't know. Heating oil, still up and away, still stayed with its bullish embedded reading. And as we come over to nat gas, I don't see this market doing anything but one of these. Now, nat gas, certainly liquefied natural gas. Of course, we got to talk how much can we send to Europe if something happens in the Ukraine. Because one weapon that, of course, Russia does have is the 40% dependence on energy that the Eurozone has from Russian oil. At the other hand, Russia will lose 40% income if they shut that off. I mean, this thing, which foot do you shoot? How do you hurt yourself? And of course, the Germans are not helping with all this, all right? They don't want to see sanctions on energy. You can't do that if you're going to go in and say you can't grab this country. It's all or nothing. You can't play that game. All right. Again, remember, we're going to have the live chat room tomorrow. That chat room's going to be on. I'll open it at 12:15. It starts at 12:30 p.m. Central Time. If you haven't got an invite from me, it means you're not on my mailing list. Or if I mailed it, it's in your spam mail if you missed it by any chance. So what do? In order to do that, just take your cursor, push it up at the top here, and you'll be fine because you'll see an icon. Click on it, fill out the forms, away you go. If you have questions on spiders, ETFs, send them to me ahead of time. My email address is on the confirm when you sign up. You'll get a confirmation with your user ID and password. Use it. I'm Ira. Have a good day.